Michael, with Australian equities and our fascination with them,
Yeah.
are Australian investors way overweight Australian equities? And if not, what should they be buying?
Andrew, I don't think they are. I think that there are a number of reasons why Australian equities have served Australian investors very well over the years, and why I think they'll continue to do so. First and foremost, in today's environment, investors are looking for yield. They're looking for reliability in that yield, and I think there's really no better place than in domestic equities for that. Australian corporates are in good shape, their balance sheets are in good shape, and they can afford to maintain, generally speaking, the dividends that they've been paying. Secondly, those dividends to Australians are tax advantaged. The imputation system, has been a great driver of returns and boosted returns for Australian investors. That's in place under no threat, and I think that will continue to help Australian investors. So I don't think the case against Australian equities is strong at all, and I'm a supporter of them.
But it is fair to say that by normal international asset allocation standards, we are overweight.
Absolutely right. But as I say, with the taxation system supporting that, I think you can make the case.
Yeah, it's a bit of a one-off. But I'd just like to look at some of the other asset classes that we ought to perhaps be considering.
Yep.
International equities, that's a logical place to look. I mean, I know you've said that you like Australian equities, so
Yes.
do I, as a matter of idle curiosity, but I know for diversification, we've got to go further. How can an Australian retail investor get access to, for instance, the major US companies?
Yeah. Well, generally speaking, the way to do it, I would argue, is via managed funds. I think it's a difficult thing to be doing on a direct basis. Australian investors have shown they are adept investing individually domestically.
Yeah.
But taking that step abroad with the different time zone, the different information.
It's expensive and complicated.
Absolutely right. And I think managed funds provide an ideal solution for that.
And what about ETFs?
Yeah, ETFs haven't taken off here to the extent they have elsewhere. I don't think that's a lack of sophistication. It's probably just something that investors don't really need relative to what good managed funds will provide here.
So maybe that's to come down the pipe. Could we just talk about some other alternative asset classes that ought to be considered? I mean, first of all, let's just eliminate government bonds, if we could.
Yeah.
You wouldn't be putting people into government bonds?
I would not at this level. With interest rates having gone down to the level they have, both here and internationally, and also the difficult state of government finances, again, increasingly here, but definitely internationally. Corporates are in much better shape than governments.
Yeah. So how about alternatives? I mean, there are a number of other, I know that's a sort of separate subset. What sort of alternatives would you consider? For instance, hedge funds?
Well, I think alternatives as a set is a difficult one, because with alternatives you've got to look at a bunch of different things, and I think grouping them and putting a heading of alternatives above those various different things, commodities, hedge funds, private equity, infrastructure, they are very, very different. For me, I have no problem with alternatives provided they are income producing, and I think income producing alternatives can be treated as investment. Quite frankly, Andrew, anything else may just be speculation. Things such as commodities, where really you are relying on the next guy to pay more than you. I'm not sure that's general investment.
Right. So we're in this funny position that we're a bit out of shape by international standards by being heavily invested in Australian equities.
Yeah.
But aside from increasing our exposure to overseas equities, you'd be reasonably reluctant to push domestic investors dramatically away from their current settings at the moment. Is that right?
I think that's right. As I say, I think that it's rooted in history, and it has served Australian investors well, particularly when you compare the returns we've been able to get here relative to our cousins in other markets in the world. I think staying at home, staying close to things things that work for you, has been a successful strategy.
One last asset class we haven't discussed is property.
Yeah.
Direct property. Am I right in thinking that it's actually a wee bit of a risk, assuming that your average retail investor's already got a house,
Yep.
their own home? Would it be fair to say that exposing yourself significantly to direct property outside your own home is maybe putting too many eggs in one basket?
I would have said so. I certainly I see property having a place in a diversified portfolio, be it on a listed basis or direct, and for investors that can have the scale to be able to do that, that's great. but it has its place, but only that place.
And I take it the big problem is the illiquidity of property. That,
Absolutely.
If you've got an investment property and you need to sell it, 9 times out of 10 it's the wrong time to do so.
Absolutely right. I mean, listed property trusts provide that liquidity and can provide diversification, can be considered, but they've run very, very hard. They've done very, very well.
Why have they gone so well?
It's that rush for yield. You know, the yields that listed property trusts provide, both here and indeed abroad, you know, has been phenomenal. But in the rush for yield, those yields have come down.
So would you say that they've probably pushed about as far as they can at the moment?
At the moment, I would say that's right. Yeah.
Michael, thank you very much.
Thanks, Andrew.